We're here for another short video clip with Trevor McCandless. He is the founder and CEO of Fusion CPA. And we've been getting a lot of phone calls regarding Hurricane Helene. What's the situation? I have losses. How is this going to affect my tax situation? Can I deduct things? What's going on, Trevor? Fill us in. This is breaking news.
Yeah, so my brother lives down in Tampa. Tampa didn't even have a direct hit, yet they had huge floods and damage to his property. And we have a lot of clients in the Southeast, and so there's floods where you wouldn't expect floods to occur, and damage and trees falling all over the place. So yeah, we're waking up to a lot of questions and texts and all kinds of stuff. And so I figured it'd be good to go over some of the high levels,
Good.
initially what's on our mind. And really, it's so early. We haven't got a lot of big announcements from the IRS and FEMA necessarily, that are triggering, hey, we know the exact dates, but based on past experience, I think we can kind of, in general, understand where it's going, right? So with some of the past hurricanes, I looked it up, like Irma in 2017, Ida in 2021, those extended deadlines that we have the 10/15 personal and C Corp deadline due coming up in here in a couple of weeks. And that has typically been pushed out to sometime in January. Expect it. We're proceeding as if that's not going to happen. That's what we always do until something is actually announced. But we fully expect that. This has been a pretty catastrophic scenario. So that's kind of what's I imagine what's in the pipeline. But I thought it'd be based on a couple of questions from clients. I thought I'd share my screen and kind of point to a couple of IRS publications of some things that do exist based on some of the questions that have come up. So let me share my screen real quick. So for a lot of disaster relief information about withdrawing cash funds from retirement plans to kind of assist with disaster relief, anything that's kind of happened to your home, et cetera. Publication 590 is a great one to look up, and you can kind of thoroughly read through it and see what may apply for you. But in general, as of now, and I could see this increasing, that you can distribute up to $22,000 per disaster from your retirement plan, and it wouldn't be subject to the extra 10% tax that is attributed to early withdrawals out of a 401k plan. Now, it's important to know, because that was a question that we just got this morning, it will be taxable, but typically in disasters such as this, it's not taxable. You have the choice of having it taxable in the current year, or you could spread it out over the next 3 years. So There's a little bit of relief there. Even in this publication, you saw it points to prior disasters that are now expired back in 2018, 19, 20 of up to 100,000. This thing is so widespread, I could see that limit being increased. So that's one kind of thing.
And that would be for qualifying expenses related to recovering your property, fixing
that would be for withdrawals out of your plan.
Okay, but does it have to be specifically earmarked for that recovery?
I don't believe so. We get into some of the fine print and nuances of any kind of scenario like this, and so that's always best to reach out to us, and one of our experts will look into it a little bit deeper on your given scenario. Some else I thought that's withdrawals. IRS is always such a great resource. You can take loans out of your retirement plan as well, and it looks like $50,000 or 50% of the balance is typically what can be withdrawn. But in case of a disaster like this, sometimes up to 100,000 or 100% of the account balance can be taking a loan out. So now there's a lot of different nuances with the retirement plan. So you always want to check there probably with your HR department, to see what kind of retirement plan you have, what you have vested, that you could have a loan on. That being said, again, we're so early in this that your HR department might not even know, and so you kind of got to be a little bit patient there. Another thing that kind of is top of mind is, and Phil Minnis, who's my local insurance guy, is going to kind of speak to, flood insurance. And a lot of places in Georgia and the Carolinas, et cetera, didn't have flood insurance, because you would never think that a flood would happen there, like in Asheville, et cetera, and parts of Atlanta for sure. And so you may have a casualty loss on the property, which means that some kind of damage has happened to the property that might be deductible. Typically, losses on personal assets are not deductible. But there's a carve out for casualty losses. And so, there's a couple things that you kind of want to look at if that has happened, and not to get too much into the calculation, but you essentially take the adjusted tax basis of the property before the casualty. And then you have to determine what the decrease in the fair market value of the property is immediately after the casualty. And so sometimes you need to get an appraisal. Your insurance company might be able to assist with that as part of their process. And so that kind of gives you your initial loss. If insurance was reimbursed, that didn't fully cover that. The difference there would be your casualty loss. So any kind of insurance reimbursement would reduce the potential loss that you have. And there's a number of other calculations that go on to help you get to the actual deduction that might occur on your tax return. But just food for thought, we just want to kind of touch on a couple high level things. The other one that has come up is the exclusion of gain on your house. If you say, hey, I'm tired of living in coastal Florida, I want to move. I've had to evacuate every year for the last 7 years, and I want to get out of here after, this insurance and stuff all works itself out. And that's just always something to kind of keep in mind, that the general rule for exclusion is if it was your primary residence for 2 out of the last 5 years. And if the property did have a casualty loss and you didn't meet that exact qualification of 2 out of the last 5 years, this is kind of falls into the unforeseeable events category, then you could be still eligible for that exclusion. So a lot of nuances in there that you would need to connect you with, but these are just some of the kind of questions that we've been getting. And so we're always trying to do a good service to our clients, et cetera. And so just want to cover those. Does that trigger any thoughts or,
Yeah, no, really helpful. I really appreciate, we're doing this video for our clients, but we also want to get it out into the public domain as well. As CPAs, we want to make sure that we're always keeping our clients informed, apprised of what's going on. So hopefully your CPA is doing the same for you as well. I think it was really helpful here, Trevor, that you actually listed those publications. So in the event you're not one of our clients, you can go to those publications and review them for yourself as well.
Yep, exactly. There's a ton of information there for all kinds of situations.
Terrific. Appreciate this. Very timely. It's September 30th, and storm just went through, and a lot of places are still recovering. So, and also, I guess, keep good records as well, especially if you have any rental properties or investment properties.
Name of the game. Yeah. Records, pictures, document as much as possible.
Yep. Film it. Absolutely.